And I'm introducing Adam Propp now after he's answered many of your questions. But all the same, Adam is Area Manager for Small Business Banking with TD Business Banking. His current position is as Area Manager Small Business with Toronto Midtown Retail District. Focuses on leading his team of small business advisors who work with him for small and medium-sized business clients and prospects to find solutions for their day-to-day operations. His team provide financing to assist with working capital needs, business startups, equipment and leasehold requirements, commercial property acquisitions, to name a few. Small business banking service to assist the client with straightforward and cost-effective solutions. In his previous roles, Adam was himself a small business advisor and personally worked with business owners striving to assist them to meet their business objectives, both with credit product solutions as well as cash management services to reduce the burden of day-to-day administrative duties. Adam also held several roles, including financial advisor in retail banking. Adam has worked with companies in food services industries, professionals including doctors, lawyers, accountants, distributors, manufacturers, developers, and property management companies. Please help me welcome Adam.
Thank you. So I was going to start off the presentation and really keep on the topic of cash management. And the reason why is that when you think of cash management, it really speaks to not only the lifeblood of your business, but it also will speak to the reputation of your business as well as how best to manage your business and the operation of your business. You may be surprised to hear, maybe to even think this, but many businesses that are profitable actually fail because they have poor cash management and poor financial management in itself. And I know for oftentimes when as a business owner, the goal is to increase your sales. And oftentimes what people will look at is the income statement, your profit, your expenses, and your net income. But the most important factor and something you need to consider, and certainly from a banking perspective that we look at is your cash management and how you manage your cash. So when we look at what's the most common business failure, it is the fact that businesses fail because they simply don't have the basic management skills and characteristics to necessary for success. In a Statistics Canada study, a number of years back that was done, the second most common reason for business failure was financial management. And some of the prime reasons, and we've heard it before a little bit earlier in terms of the presentation, is being undercapitalized. And as I mentioned earlier, I used to be a small business advisor and I worked with a number of startup businesses. And one of the examples that I use oftentimes when I give a presentation on cash management is being capitalized. I don't know if you ever watched HGTV where you see people who renovate houses and they're determined that when they sell their house it's going to be on this date no matter what, and they're going to stay up 24 hours to get everything organized and sell it. I had clients who came to see me. They were partway through opening up a restaurant. And they came to me, talked to me a little bit about financing. And I said, this is what we're going to need. And I talked a little bit about it before at the Canada Small Business Financing Loan. I said, we're going to need to see a business plan. The bank's going to want to see your financial projections. We're going to want to see your startup costs. In order to assist you with the financing, these are some of the elements that the bank is going to want to see. Well, the customers themselves said, no, it's okay, we're partway through. This is the opening date of our restaurant. We're going to go ahead and do it ourselves. What had happened was the individuals themselves had been in the industry for 10, 15 years working in high-end restaurants and knew the industry in and out, much better than most people that I've ever encountered. But the challenge was they didn't think of what they needed to do to get the business open. So they had all strong credit histories. And because they didn't approach the bank first and they didn't get the appropriate advice, they got as many credit cards as they could based on their credit history, took out as many lines of credit as they could, and started the business. And so the business got open, just like they said, the date they were going to open it, they opened it. I went in, it was a beautiful restaurant, I loved it, I enjoyed going there. It didn't pick up like they initially anticipated. And they came to me and said, okay, well now we need some financing. So thankfully, the Canada Small Business Financing Loan steps in and it is able to assist because you can do financing 180 days after the expenses have been made. That being said, it wasn't enough at that point. They had well exceeded what they needed, what they should have spent. They went to friends and family, and ultimately in 2 or 3 years the business closed. They weren't able to succeed. And this was without taking salaries, and it's really as a business owner, or not as a business owner, probably as a banker and someone who worked with them, it's hard to watch because it was really truly a failure only because they didn't forecast in the beginning. They didn't take into consideration capitalization. So when you're thinking of financial management, when you're thinking of startup businesses, it's something you want to take into consideration right from the onset. Another factor in terms of poor financial management, in terms of operating your cash flow, also has to speak to recording of accounts receivables. It's key to make sure that when you have money that's owed to you, you know when it's due, who owes it to you, and when you're going to receive it. I was a small business advisor for 3 years, and I worked in a branch and dealt with companies right from startup to existing who had $2-3 million in sales. And irrespective of the size of the business, it didn't seem to matter who they were, they would still have a cash flow problem. And there was one business in particular that I can remember that would call me every year, and I would sort of say, is it that time of the year that I'm going to get a phone call where I've run out of money, I've got a check that I'm waiting for, I've got to make payroll, I have to pay taxes, but I don't have the money available to me. So when we're thinking of when you're starting your business, no matter what stage, if it's in the beginning, if it's in the middle and you're growing, you want to be forecasting and make sure that you also have good controls in place. So a goal of good cash flow is to have enough funds on hand when you need it. It's a simple concept, but in practice it's not always followed through. The important part is that when you're thinking of your cash flow itself is that you can't only focus on the day-to-day activities of your business, you've got to think of the future. Because if you're strictly living in today, you're going to miss projecting what you need to do for the future. So when we take a look at what is cash flow and why it's important, and when we look at reasons for poor financial management, some of the reasons that we've seen are people not having a proper or realistic business plan. So again, if I use the example of the clients that came to me with the restaurant, is they hadn't thought it through. They hadn't thought through, what is my business going to be? What am I going to need in order to get my business started? What am I going to do if there's going to be a shortfall? Another reason is not having contingency. What do you do if there is a shortfall? What happens if your revenue isn't what you expect in that first month? Because it's great to sort of put through what your projections are, but there's going to be anomalies, there's going to be things that impact your ability to get the sales for that first 2 months, 3 months as you go. What's your contingency? Do you have adequate cash flow? Do you have the personal resources that you are going to need to inject into the business in order to allow you to be successful, to make your bill payments? Break down the financial controls. As your business grows, you may bring in a bookkeeper, you may bring in other people to assist you, but you can't as a business owner walk away and let that be in control of somebody else. Because when that happens and you lose control over your own finances, when things go missing, when you don't know that something hasn't happened. I've seen very successful businesses who've engaged bookkeepers to do their banking for them and to pay their taxes, and taxes don't get paid. And next thing you know, they get a requirement to pay. And what happens when a bank gets a requirement to pay is that we get a notice from the government saying X number of dollars in taxes are owing. And what that means is the bank has to put a freeze on the bank account. And when that happens, if you're a restaurant, or any business actually, and I'm thinking of a restaurant just an example that it happened for one of my clients, you can no longer pay your rent, your landlord could lock you out. You can't pay your suppliers at that point in time, and when we talk about reputation, making your payments on time is everything. And ultimately, these kind of things will impact your business, irrespective of how great of a job you've done in running your business. It can unfortunately be the result of having to close the doors because you've sort of lost control of your own financial management. Not managing account receivables. Again, I spoke to it a little bit earlier. You don't ever want to be in a situation. The bank is there to help, and we will help. We want to help. I certainly don't want to see checks get bounced. I would never hate to see that your employees don't get a paycheck because we couldn't assist, but nothing's more disconcerting to a business owner when you're trying to run your business to have to think, oh God, am I going to get this check in the mail in enough time to make this payment? So you want to make sure that you're managing your accounts receivables. And I will, at the end of the presentation, speak to some solutions to help manage accounts receivable or manage your cash flow. So hopefully we'll address one of the questions that was raised in the beginning. Poor cash flow management. And I've also come up with some symptoms. So, if you ever watch the TV and you see these cold and flu advertisements, you have these different symptoms. Well, there are symptoms to know and help you diagnose whether or not your business is having cash flow problems. One is that you're not able to pay your trades on time. You're not able to pay suppliers. You're sort of holding off because you need that money to be in your business. Another one is that you're concerned that customers' checks are coming in the mail each day. Nervous about making payroll every 2 weeks. Hesitant to take on large orders. So again, if the goal is to increase sales, you may not want to increase your sales if you know that you don't have the money available to you to make your expenditures. You're unable to commit marketing dollars to your business, and then you're seeking infusions of cash from family and friends. And these are all classic signs that you're having cash flow problems. I think the one important thing to keep in mind, and I think we've talked about it before, there's a difference between your cash flow projections and your income statement. So just because you're profitable doesn't mean that you're going to have the cash flow to be able to meet your needs. But there's good news, of course, and as we say, and a lot of times you'll see statistics that in the first 5 years of business, the businesses don't succeed. And so I think that where we want to understand is that when you manage your cash flow effectively, you're going to increase the odds of business success. So when we look at startup businesses and how you have access to capital, I know it was one of the questions. Banks for startup businesses are going to be turning to the individuals a lot. Irrespective if you're a sole proprietor, if you're a corporation, there's going to be an element to what you bring to the business and bring to your banking. Because we as a bank and as customers, we work in a partnership with one another. And for that reason, oftentimes you'll have to utilize your own capital to help get the business started. We'll also look in terms of having a partnership in terms of there will have to be an element of a personal guarantee. And which is helpful, certainly, because it speaks to your net worth and your ability to repay back the debt. And sometimes even when you're looking at guarantors, it will help in terms of getting the initial capital that you need to start up your business. But the reason why you want to take a look at how you operate your account and how you manage your cash flow is that you build a reputation with the bank. And when you think of having a good reputation, it's not just with your suppliers and vendors, but it's with your bank. So you have to think that you don't want to write a non-sufficient fund NSF check to your vendor because they're going to look and say, well, if they gave you terms, and I know there was a question about a term before, and that might be a term sheet, but oftentimes you get terms from your vendors, which means that you have the ability to repay them back over a certain period of time, whether it's 20 days or 30 days. It's a credit that you have with them. And so if you're not paying them on time, the risk that you run is that, from a reputation standpoint, is that they're no longer going to give you those terms. They're going to say, well, we want payment in full today. On the date that we make a delivery, we want to get paid. Similarly, from the bank's perspective, if we don't have a credit history with you as a business owner, we're going to look at how the business account operates. And so if there's a number of NSF checks, it calls to question as to how strong the cash management is, how strong is the financial management of a business. So you want to take that in consideration because it's important that your account is operating well because it lends credibility to your business. When the banks look at financing in the beginning, we will look at the person themselves and the credit history. So a large component, there's sort of two elements of the banking, I think, is as you grow your business. And thankfully, I'm joined by my colleague Sharon from our commercial banking group. In the small business banking realm, we certainly look to the individual in terms of their credit history from the beginning, in terms of their ability to repay back the debt. Because the business, as Alan pointed out, doesn't have a credit history. So we look to the individual. What kind of credit history have you had in the past? Because it speaks to your ability to repay back on your personal debts, lends to what conceivably is how you pay back on the business as well. And so it's an element that we will take into consideration, and most institutions will, in terms of the credibility of a business reputation and the ability to borrow funds right from the onset. Let's speak to the question. Is there any questions? Or I know I've been flying through, so I should stop and ask if there's any questions that have come up so far.
I just want, it's an add-on question to the same question.
Mm-hmm.
So, I might have plans to start a business in the future, and currently I have a personal account with, say, a bank X, and tomorrow if I go to start a business and if I need a loan, should I first approach my own bank obviously I would go and approach my bank, and if they don't give me the good terms, and if there is if I know that there is some other bank which is going to give me a better term, so if I go to them, would it, because I've never had a relationship with that bank in the past, so will that affect, or do I have to, if I have to plan in advance to open an account even before I go to them for a loan?
I always find, no matter whenever you're looking for financing, you want to be educated. And I think it's important to go out, irrespective of whether or not I work for TD or any institution, you want to go out and talk to different banks to find out what they have available. Obviously the most logical place is to start at your home bank, because you may find that it's a little bit easier to get approval because they know who you are. They know about you, they know about your banking history, they have your assets or loans with them already, and so there's a comfortability already, right from the beginning. And you may be able to get more favorable lending, when you go to your home bank. But it would never mean that if you were to go to another institution that they're not interested in your business, and it's going to be any harder to get borrowing. So I think it's important to go to an institution and find out what it is that you're looking for, what the solutions are that are available, and whether it's your home bank. And what I do caution a lot of new business owners is whether you were, and I say the same thing to young people who are trying to get credit for the first time, is you want to go and educate yourself up front, but you don't want to do an application every single time. Because credit history is everything when you're doing a startup business, because again, ultimately the business is you. And so it's your credit history that oftentimes may dictate your ability to get a loan or not. And for those who may not be aware, every time you do a credit application, your credit bureau gets pulled, and it has a negative impact on your score. So it can bring down your score if you went to 4 different banks and did an application in each one. So one of the things to keep in mind is that when you're going, it's to have a conversation. You talk to them about your business. This is what I'm looking to do. This is the type of financing I'm looking for. What kind of rates can you offer me? As a startup business, will I require a guarantor? Will I require security, some kind of tangible security? And find out from them what they have to say. And talk to another institution and see what they can offer. You want to find, it's not just, interest rate is going to be one thing, and there will be different banks will have different interest rates. You want to also take a look at who you're dealing with in terms of your partner. It's one thing, it's great to get a great interest rate, but if you don't have a good business partner that you're working with, the interest rate is not going to mean as much down the road. And it's the same, I think, in everything. Sometimes you pay a little bit more, but if the service you're getting is there, then it's an important consideration about your business, because you want someone who understands what you're doing and is there to help you as a partner. So, something else you want to take into consideration. Any other questions? Yes?
Do you guys TD has paid programs regarding the management of cash flow?
In terms of how to manage your cash flow, in terms of how to collect money? So we do. There's a lot of electronic services that are available to help you manage cash flow. So are you talking about having money coming into your business?
Yeah.
Okay. So I will talk about it at the end, but if you want, I can, don't have to be structured in terms of the presentation itself. In terms of cash flow management and what's available to you, cash flow management is getting money into your business quickly. So depending on the type of industry you're in, there's different services that might be available. So one consideration might be merchant services, like a Visa terminal, where if you can collect the money from someone rather than waiting for a check in the mail, and they can pay you via credit card or debit card, and it goes into your account right away, that's a great opportunity. Another service that we provide is electronic funds transfer. An electronic funds transfer is money gets debited from your bank account automatically. So think of it like a loan payment. You give someone a voided check, even if you belong to a gym, you have a gym membership, and they ask you for a voided check, and they'll take your monthly premium out or your monthly gym membership payment out on a monthly basis. That's an electronic funds transfer. So again, it eliminates having to wait for a check to come in the mail. Certain businesses may qualify to be a bill payment receiver. So when you think of it, when you go home and you pay your Bell or your Rogers bill and you go online and you click and the money goes and pays, banks offer that as well in terms of another method to be able to collect your money owed to you faster. Again, it's always going to be industry specific. And the other thing to keep in mind is that all these services have a fee that's associated with it. So depending where you are within your business, it may not make sense to engage in all of these different services up front because it unfortunately takes away from your bottom line in terms of the fees that are associated. But those are examples of services that are available to help you collect money into your business sooner. Is that what you're looking for in terms of, does that answer the question? Yeah. Yes?
You mentioned something about the 180-day window for the
Small business financing loan?
So that means after 180 days of operation, you're not eligible anymore?
So it's not of operation. So how it works, so the Canada Small Business Financing Loan, we'll talk a little bit about the loan itself and then a little bit about the rules too. So as I mentioned before, the Canada Small Business Financing allows for access to capital for either existing businesses, so you don't have to have just started your business, or it can be for a startup business. And it allows for financing, the Act allows for financing of up to 90% of eligible costs. So if you had startup costs of $100,000, you're allowed to get financing up to 90%. And I'm really focusing on the word up to, because while the program itself is sponsored by the government, it's offered through the banks. And each financial institution may set their own lending criteria. Eligible expenses, I think I mentioned before, would be leasehold improvements, equipment, there is software development that's included, and then real estate as well. So the 180-day rule goes as follows. When a business is approved, the date of the first advance of the loan, so if you can do it in multiple draws, you can be anywhere from 3 to 5 draws in terms of when you pay out money to suppliers or to vendors. You have to draw out the full amount of the loan 180 days after the first draw. So if on January 1st, you took your first draw to pay, let's say it was $300,000 was your loan, and you needed to pay out $100,000 up front, you were paying in installments. And you paid $100,000 out on January 1st, you have until June 30th to draw out the rest of the loan. Now, it also works in the reverse. If you had decided, this happened once, I had a client who opened up a bar, and they came to me before they got started, and then I didn't hear from them, and they did all the work and then came back to me. If you have spent money within 180 days of getting approval on the loan, that's also eligible. So the 180 days falls on two sides, on the date of the first payment going out, or if it's, again, if we use January 1st, as the day you get approved for a loan. If you spent money in 2012, January 1st, if you spent money from July 1st, 2011 until December 31st, if you kept copies of the canceled checks, if you kept copies of the invoices, then those would be eligible expenses that you could turn to the bank and say, can I get financing against these? But again, I highly recommend sort of doing your research on this loan and coming in and speaking to an advisor at any financial institution to talk to them about it, because the one big benefit to it is, and I think I mentioned earlier, is the limited guarantee. Typically, you walk into a financial institution today and you say, I'd like to borrow $100,000. The bank is going to ask for what's called typically an unlimited personal guarantee. So you're going to be guaranteeing that full $100,000 amount. With the Canada Small Business Financing Loan, if it's a corporation, it's limited to 25% of the loan amount. So, if you're borrowing $100,000, the business doesn't succeed, your guarantee then gets limited to 25% or $25,000. It's applicable only to corporations. As a sole proprietor, you would still have 100% guarantee. And the benefit to it is it's easier to get access to capital, because when you think about it, when you start up a business, as a business owner, chances are you're putting all of your capital into the business to get started. And so you may not have that $100,000 of net worth that the bank is going to look towards to say, can you repay back this debt in the event of default? It's easier when the guarantee is limited to 25%. It's a lot easier to say that you have a net worth of $25,000 after all your expenses have gone in versus $100,000. And that's why, and I think I mentioned it before, and as a business gets started, oftentimes we do require a guarantor, because net worth, irrespective of your age, you may have a limited net worth because you're a young individual, or you could have changed industries. A number of different factors could have impacted your net worth at any point in time in your life. That would suggest that you may need an outside guarantor to assist in terms of getting the financing. Because with a startup business, it's really, it is about the individual themselves to start. Whether it's your credit history, whether it's your personal net worth, those are all going to be primary factors that a bank is going to look at when assessing the ability to give financing.
Thank you.
You're welcome. Any other questions? Yes.
I wanted to ask that the top 5 banks offer the same kind of lending rate and other offering terms for small businesses?
We offer the same type of financing options.
Yeah, for other, I mean the top 5 banks.
All the big 5 banks have the
Yeah.
same. I would suggest that they do. I think when I think of it, there's really only 2 types of financing. When you break it down to the most simplistic terms, there's really only 2 types of financing that it's available. It's either a loan or it's a line of credit. It's either something to finance fixed expenses or operating. And I know I'm making it overly simple, but I'm just trying to look at it more from a simplistic standpoint. Most of the institutions are going to offer the same products. You know, there's only 5 banks in Canada, so it's hard to be too creative. But at the end of the day, I think that what you will find is there will be differences in terms of how we lend, the criteria. This is, I said, the Canada Small Business Financing Loan. Certain financial institutions will go in and out of it in terms of their love for it. We're lending everybody at this percentage, and then we're pulling back. And so that's why it's important to sort of be educated in terms of what's available, how do the institutions lend. So to give you an example, if you look at lines of credit for working capital needs, day-to-day operations, some institutions, and I can speak to TD, we lend on to the penny in small business banking. Think of your line of credit like a large overdraft protection. Other institutions will lend it where it's almost like a transfer from an account into your business. And it's separate. So if you wrote a check for $1,322.19 and you went into your overdraft that amount, that's how much interest you pay based on that dollar amount. Whereas with another institution, they may transfer $2,000 into your business account. So you end up paying more interest on that specific dollar amount. So again, everyone has a different way that they operate. We all offer the same credit facilities, but it's about educating yourself to find out what works best for you, what platform do you like the best.
So, you mentioned about bringing in a guarantor. What is that you look for in the guarantor? He has to qualify on the same credit score and stuff?
Correct. So the guarantor that you're bringing onto an application, you want them to add value. So if there's a weakness in the applicant, is you the business owner, you're a guarantor as well. But we're thinking more on the third-party guarantor. So you want them to add value. So you wouldn't want to bring someone who has a poor credit history or a nominal net worth because they're not adding value to the application. From the bank's perspective, it's not someone we could turn to in the event of default. So you're looking at someone that can, in the event of default, has the capacity to repay back the debt if necessary.
That is up to that 25% that I'm liable to.
Specific to that loan itself. So it's not, the important part you'd always want to find out is what the guarantee is, what the liability for that individual is. When you're in and you're applying for the credit facility, you want to ask. You may come in and apply for a line of credit, and it may be for $25,000 as an example. We don't have to always think in terms of large figures. And again, you may require a guarantor. So on a line of credit, their guarantee would be for the full amount of $25,000. So it's important to understand what the nature of the guarantee is. And you yourselves, if ever you are a guarantor, you too want to make sure you understand what your liability is. You want to make sure that the person that you're guaranteeing for has the capacity to pay back, otherwise you might as well consider it a free loan and free gift of money. So, you had a question as well?
Yeah, I just wondering about giving a specific example of what an existing business applying for Canada Small Business Financing Loan.
Okay.
One had a technology startup, and the technology startup was developing a product, and then you go into the phase where you're going into manufacturing. Would one apply for a Canada Small Business Financing Loan at that point?
For the manufacturing? Possibly not. And the only reason why I say that is I'd have to truly understand what the expenses were. Because the Industry Canada will set the guidelines in terms of what's eligible and what's ineligible. And it's very clear, like thankfully on the website itself, it will explicitly state what's not eligible for financing. So goodwill, for example, is not eligible. working capital is not eligible. Unfortunately, we can't pay accountants and lawyers and those types of expenses under the Canada Small Business Financing Loan. So I know I'm giving you a very vague answer, but if you were to ever sit down either with myself, a small business advisor, and say, these are the expenses that I'm looking for, would this be eligible? We could very clearly look it up and be able to tell you. Because if you were manufacturing something and you needed to create the part specifically to do the manufacturing, that might be eligible because so we have to take a look and see.
What about the equipment to actually manufacture?
The equipment, if you were purchasing the equipment, definitely. So equipment is eligible under it.
So
Yes.
do the salaries qualify? Like in a software-based business, the whole cost is like salaries mostly?
Unfortunately not. Salaries are an intangible asset. Really when you think of the loan, the government's looking at and the banks are looking at something they can put their hands to, really to collect if they had to repay back. So in the example given before, if it's equipment, we could sell the equipment if we need to assist in repaying back the loan. Now, it's not always true because I kind of laugh, we could do leasehold improvements. So if you look here, the carpeting and the paint on the wall, that's eligible to be financed, and the bank's not going to rip up carpet and start shaving paint off the wall to repay back the loan. But there's certain things that are eligible and certain things that are not, and salaries, unfortunately, are ones that are not. But again, software development, again, depending what it is if you're doing it yourself, and I truly would suggest come in and speak to an advisor so the two of you can look on the website together and sort of get a good sense. When I did financing for a software development company, I made sure to take a look and get a good sense as to what they were asking, what they were looking for, so that I could see if they were eligible or not, because software gets very tricky. So we want to check just to see if it would or not. I just wanted to share a few things just to sum up a little bit, because I know one of the questions that came up, it spoke to how to take control of your cash flow and ways to take control. At the top of the circle, it starts with managing your invoices. And I can't stress it enough. I find it funny myself that people don't always invoice. We've had people sort of, when we've given this presentation, say, I've had someone come do work for me and I never got an invoice from them ever. They gave their work away for free, their time away for free. So, right from the start, make sure you send your invoices out. The second one is to manage your payables. One of the important parts of cash flow management is you want to keep as much money in your business as long as you possibly can. So it's good to know who you can pay and how long it takes to pay them. So if you have a business that says to you, we're going to give you terms to be paid back in 30 days, may not pay them back on the first day or the 5th day. Maybe you wait till the 25th day before you make the payment, but you want to make sure it's on time so you don't impact your reputation or your credit. Another great one is to pay with your Visa card. And I think Alan had mentioned a little bit before, it's not a tool that I recommend if you're having cash flow problems, but when you pay with your Visa card, if you had a receivable or a payable that was due in 30 days, and you paid that with your credit card, you've now bought yourself another 21 to 30 days of interest-free money that payable has to be made. It truly only works if you're going to pay that credit card balance off in full. Otherwise, you're paying 20% interest. But if you can hold off, and we make the payment the last possible moment, and if you need to buy some time to make that payment back, and it's eligible to be paid on a credit card, it's something you may want to take into consideration. Get a credit line before you need it. There's two aspects to it. And again, it's about forecasting. You need to know, and I think the question was asked earlier in the presentation about how often you should review your budget. Think of it like a financial plan. You want to look at your investments anytime there's a major change in your life. Well, you want to review your business every time that there's a change in your business. If you're going to be taking on new sales, and you want to make sure that you've got the ability to handle those sales. But the same token, if you anticipate troubles in your business, you want to be talking to your banker ahead of time. We recently had a client of ours that's been a banking client for 18 years, who on the time that he bought out his shareholder, his partner, also happened to have a 6-figure loss in his business. And when we see that as a bank, that throws up red flags, and we think about maybe we need to cancel a line of credit. When we sat down with him, and probably over 6 hours and 3 different meetings, we really got to know our customer. And not only did the line of credit stay in place, but as a small business client, with a $100,000 line of credit, we brought him over to commercial, which was the appropriate channel, and increased his line of credit from 100 to 500,000. But what the client said in the office really stuck with me, and that's why I'm saying it today, because it's only happened in the last couple of months. He said, with all of technology, I do my online banking, I bank at the bank machine, I never went in and got to know my banker. So when all of this happened, you knew nothing about me. You didn't know that my partner may have had all the net worth, but I was the guy who ran the business. He knew nothing and I knew it all. And these are all the steps that I took to fix everything. And when I take a look at the bank account, flush in terms of money, operating with large receivables, doing great, only over a span of 6 months, but he had no one to tell this story to because he didn't have that relationship. So irrespective of, you want to have that good relationship with your bank, and I think, and it's great that Sovereigns has invited us to join with them today, because the more your accountant and your banker and you talk together, the easier it is for us to move you forward. Because we know, there's tax strategies that are in place, and as I said about Sharon having a heart attack, there's certain things that the bank wants to see. And so, they sometimes compete with one another, but most importantly, if we're all on the same page, we can offer you the appropriate solutions. Increasing cash sales, what that means, obviously you want to get paid, but sometimes it may benefit to offer people terms. Sometimes you may say, if you pay me net 10, which would be paying net 10 days, I'll give you a discount on your payment by 1 or 2%. It reduces your revenue in the sense that, yes, you're not as profitable on it, but it's not by a huge margin, it's 1 or 2%. But what it does do is encourages people to pay you faster. So where applicable and where you have the ability to, you may want to consider offering these types of terms to your clients to help them pay you a little bit faster. The last one, second to last, reduce fixed expenses. You have to take a look at where you're spending your money. I had a client just before the recession who used to do executive search, and he would place people, and contracts were all over the world and in US dollars. And around the time he decided to rent a big, about the size of this boardroom for his office and build himself a $1.6 million home and get a BMW, is the time the recession hit. And what he realized when he sort of sat back and said, you know what, I don't need a boardroom this size, it's only me, and I don't really need to hire this other person right now because I can do this job myself. I can do this from my house. And sometimes you'll see conference centers where you can have a small office and have the benefit of using their boardroom, but you call in and it's hi, you've reached whatever institution or business it is. It seems very professional. You can reduce your overhead. And again, it will help you from a cash flow perspective. And last but not least is reduce your inventory. There's no benefit in sitting on inventory. There are companies out there sometimes that will be able to purchase your inventory at a discount, obviously, and sell it for you, but rather than it sitting somewhere in a warehouse, or if it's a small business in your basement, not earning any money, if you can have someone sell it on your behalf and get more cash and revenue into your business, and sometimes it's something you'd want to look at to move forward. So what can you do? Again, how to help benefit yourself is create yourself a business plan. Treat a business plan like a living document. It's not there for your first 5 years of your business only, because what you achieve in your first 5 years is not what you hope to achieve in the 5 to 10 years. The more you revisit your business plan, the more you change it, the more you're going to stay ahead of the game and be more competitive in the business. Document all your assumptions. Use free tools available to you. I encourage you to take a look again at websites financial institutions offer, because they oftentimes have great resources available to you. Whether it's economic information, whether it's business planners, cash flow planners, whatever it may be, there's a lot of resources that are free that are available to you as entrepreneurs that you can take advantage of to give you some information. And most importantly, ask the experts. Speak with your bankers, consult with accountants, whomever it may be that will give you the appropriate advice and direction. For those who didn't receive, we brought cash flow books over just to sort of give you some examples, something to look at. We have more if you do need any. Just one example of what's available to you. And I guess we'll wrap it up with more questions if there are any. And thank you very much for your time. Outstanding. they'll give you a term on it so you can get money into your business ahead of time. So when the receivable comes in, it goes to pay back the money that's owed to the factoring company, and I think the balance outside of any interest charges come to you.
Banks will not, commercial bank will not finance purchase orders. So sometimes companies get in a situation where they've landed a very large client, they're going to need to pull in inventory to support that purchase order. We only finance receivables. The receivables can only be created once the work has been done and the product's been shipped out. So we do know a number of factoring companies that can assist businesses as they get over that hurdle, and they will take on the risk of a purchase order. The financing costs are more than conventional bank financing, but sometimes it is a necessary evil to move through as you grow. So
And-
we know many reputable ones, so we're always happy to refer you to a few if you need it.
Any questions?
Yes.
As a business, so beside the business loan, can you guys offer something else, like let's say waiver the fee, like monthly fee for bank account or something else?
Can banks do it? Banks can do probably anything. There's always an exception to everything, but
like, that's good to know, because when you go and speak with your banker, you know what you can ask.
yeah, you can always, I mean, it can't hurt to ask. Is a bank always going to waive fees? Probably not. Because to be truthful, banks, it's a business, and so there are fees that are involved in it. But I would encourage you to talk, because every institution has different plans that are available, some that are lower cost than others. There are institutions that I think will have no cost banking, sometimes more of the virtual banks do. I can't speak to all, like I don't know, from an ING or from a President's Choice whether or not they have no fee banking options available. I know sometimes on checking accounts they do. But you always have to watch, and it's to be truthful. When you don't pay fees and it's a virtual institution, it has its upsides and it has its downsides. And an example, that I can give it's fair, and I'm not speaking to any one institution, but if you need a draft and you cannot go into an institution to get it, you have to wait 3 or 4 days for you to receive it, it could have an impact on your banking. So it's something to consider is the lower cost option, is it going to have that benefit to you or not? But I certainly encourage you, because there's always promotions that banks have going on, where they may give you, if you sign up a new account, you'll get a rebate X number of dollars. So while they may not waive your fees, they may say, well, if you set up a new account, we'll give you a $100 rebate to your business account. Well, that may offset 5 or 6 months worth of your banking fees. But again, it's about, I encourage you again to go out and do your research. Go online and take a look to see what different banks offer for service plans and service charges, and where the low-cost options are. Because you don't have to be spending $10, $15, $20, $100 a month on your banking. Some institutions will offer it at very low cost. So, but yes, ask. Ask the question. Some will be honest with you and say, yes, we can waive first 2 or 3 months. If you don't ask, you'll never know, right? Thank you very much again. I appreciate it.